Welcome back, team, to another CFFX video. Today we're going to be doing something slightly different. I'm going to be going through some of your questions. I've got a list of 10 questions that you guys have asked me. We're going to talk through those. I'm going to go through the answers, and yeah, let's see how we go. If you haven't done so already, please make sure you like the video, pop a comment below, and subscribe to the channel. And of course, don't forget to pop that notification bell so you can be notified when the next video lands. I'm just at the moment releasing the videos to my supply and demand section of the Beginner to Winner series. If you haven't got a good understanding of supply and demand, or even if you have got a good understanding of supply and demand but want or need a bit of a refresher, please go and check those out. I really appreciate the feedback and you guys tuning in and watching them. So I've got a list of 10 questions we're going to go through today from various members in the mentorship and a couple from Instagram as well. I'm going to talk through them one by one. What I will say just before I start is that everybody trades completely differently. I trade a certain way, and I've got friends that I trade with who trade similarly, but sometimes we'll have completely opposing views. Jake in my mentorship, Keem in my mentorship, we'll often trade completely differently, but we'll all make money. So anything that I'm going through today is really my views, my opinions on this. It's potentially not absolute fact. This is, based upon my experiences of my trading, and, hopefully I can teach you guys something today that you can take into your own trading. But, often there are, many ways to skin a cat, as they say. And ultimately, whilst the things that I go through are right and correct based upon how I trade, there may be opposing views on it as well. So yeah, let's get into it. So question one was how to check whether a trade has become invalid after entering. Well, it's a tough one to answer, really. Personally, I'd say you shouldn't really be taking any trades that don't completely meet your plan, and therefore, if you take a trade and it goes in the opposite direction, that doesn't necessarily mean that that trade was invalid. The market will do what it wants. There's obviously various factors that push price in one direction or another. And those factors are, how many people are buying, how many people are selling, the big institutions and the amount of orders they have in the marketplace. And of course, there's the algorithm as well. This mysterious algorithm that kind of fluctuates market price that we'll never fully understand. Nobody fully understands why the market does what it does. And all we're trying to do is play out an edge. A really successful trader might win 60% of the time, maybe 70% of the time. If you ever see anybody who's trading and taking these trades and they're winning 80, 90%, they're lying. It's as simple as that. Nobody wins like that because the market is completely random. And you could take the most perfect trade ever and it goes in the opposite direction. And you could take the most, rubbish trade ever and it goes in the right direction. It can be completely random. Now, what I teach and what we do within my group is we trade the probabilities and we trade an edge. So how to check whether a trade has become invalid after entering? Well, usually you'd be looking at, the Bitcoin trade here is a good example. So I was looking at this, it met all my criteria. I've had different breaks of structure. I've got a nice arcing area. I'm in a really nice kind of higher time frame supply zone that I want to be trading from. And I entered after I had this second break of structure, which for me on, the 5-minute time frame, for me, I'm pretty happy with that all day long. I'll take that trade, especially when I've had second ones. It started to move into my direction and it hit this weak demand zone that I was expecting price to blow through. And obviously we've had a push up here. Now, I personally would say that this trade is potentially invalidated as soon as the trade moves in an opposite direction. So see here, we've then got a break of structure above. That for me kind of invalidates the trade. Am I going to take the trade off? Well, no, because this is why that stop loss is there. And I know that there's value in all of these areas. Let me take out this zone here, okay? And I'll just draw this. This is an area that has not yet been broken. So although we have pushed higher and we've created a new breaker structure above, this trade isn't invalidated completely until we break this zone and until we break this area here. That's when the trade is invalid. Now, by that time, you're pretty much near your stop loss. It could just wick up and then reverse and go in the right direction. So the question, how to check whether your trade has become invalid after entering, well, obviously breaks a structure in an opposite direction would be the reason why a trade is now invalid. However, you should be framing your trades in a certain way where there is room for the trade to breathe, there's room for the trade to do what it wants, and there's room for the trade to potentially break structure and return. Because, you know, a really common play is a raid of the highs. Think about all the early sellers here that are now potentially caught. If price does this and it taps that and comes down, well, it doesn't take out much liquidity. If price, however, breaks that and then comes down, then it does. Now, obviously, this looks like it may break and take my stop out, and that's absolutely fine because I've entered my trade and my trade wins multiple times, 60% of the time, 70% of the time, my trades will win. In a good week, I'll take 70% strike rate. In a bad week, I'll take 50%. But my edge always plays out. My wins always outweigh my losses. And so checking whether a trade has become invalid after entering isn't something I'd worry about. When you take a trade, you should see it as a loss initially, as in that money is gone. You've taken the trade. Canceling your trade here, or when you get this first break of structure, is a surefire way of ruining your edge. Because then if price comes back up and back down, and then ultimately ends up in a win, you will kick yourself for coming out of it soon. So set your trade, set your stop loss. If it loses, it loses. If it wins, then great. But there's no point in setting a wide stop loss or setting a stop loss above here. If you were saying to yourself that this trade is invalid, if it breaks that structure to the high, well, then your stop loss should be there as well. If you're saying it's invalid, if it breaks this structure to the high, then that's where you leave it and you don't touch it. So I wouldn't be coming out of trades early personally. And honestly, if you're trading like that, it's because you're not 100% confident with your trading strategy. This is where you want to be back testing. This is where you want to be writing out your rules. This is where you need more experience in the marketplace. So I wouldn't be closing a trade early is the long and short of it. I'd be waiting until my stop is hit or my first take profit is hit, and that's it. Okay. Question number 2 is how to close a trade with maximum RR. Well, look, this is something that is personal to every trader. And this is where your trading plan and your back testing and all of the journaling that you should be doing will come in. Now, I'm going to make something really, really clear. If you're not back testing almost once a week, you are missing out on progress and you're missing out on wins. If you're not journaling every single trade, and that means writing out a trading, let me just show you mine. I think I've got a quick one here somewhere. Writing out a trading journal, okay? Writing down your trades, where you took the trade, what your confluences were, the reason why you took the trade, a copy of a job. You should be doing this every single time that you enter and every single time that you trade. If you're not doing this, then you are missing a trick, okay? That's the first thing I will just say on that. Now, in doing so, you'll have experience in the marketplace and you'll see where your trades get to. You can write out comments such as, took the trade off at 4R, but trade ran to 10R. Now, if you see that happening over and over again, you know that you need to change your trading plan to hold to 10R. It's as simple as that. So closing the trade with maximum RR is something that's personal to you. Now, I know some traders who will enter like this. They'll wait for this low and they'll come out with a 7R. They're really happy with that. Myself, I like a wider stop. So I'm coming out. I'm not even taking my first take profit till after they've taken their final profit. It is personal to you and how you trade. Personally, I think taking a wider stop when you're less experienced and taking less R is the most profitable way. Okay. Yes, I might miss out on some lovely 10R trades or whatever they may be, but those same 10R traders are taking a lot more stops than me. So let's say you did a tight stop. Yeah, look, you're getting out at an 8R if this wins. Well, that's great. But also that person's been stopped out because price has moved out, whereas I'm still in the trade up here. So it's personal to you ultimately. And the way that you trade is really important to develop your own trading strategy. If you're new to this, I would say take a wider stop, aim for less R, because that 100% is more profitable and you're more likely to get more wins. If you have one of these rare minds where you can deal with multiple losses over and over again, then knock yourself out. Head for the 10R trades, 8R trades, 20R trades, whatever they may be. You'll see everything on, Ment FX. Me and Jake were talking about this the other day. Ment FX has recently released a video where he's in a 200 to 1 trade at the moment. It's fantastic. but he's a professional trader with, years and years of experience, and he probably doesn't catch them all the time. And when he does catch them, he probably gets loads and loads of losses before he does. Ultimately, very experienced traders can take these big R, but you are not yet that experienced. So my suggestion would be to take a lower R, take a wider stop, and get good at taking 2R trades regularly. Get your 2R trade, come out of the marketplace, make some notes. If you can take a 2R trade over and over again, the power is in the numbers, and get really good at taking 2R trades over and over again and winning 2R trades over and over again. If you can do that, then fantastic. If you can't do that, then you shouldn't be aiming for anything higher. That's the bottom line, okay? And closing the trade before the stop loss. Well, again, I wouldn't close a trade before a stop loss. It's as simple as that. If you're closing a trade before a stop loss, then your analysis is wrong and you are not experienced enough to take your trade. Look, I've come out of this trade. It's whipped me out. This trade is now dead. That's absolutely fine. Doesn't make any difference to me. It's just another loss. And what we might be doing here is wicking above. And as you can see here, pushing back down. Look at that move now. It's almost exactly as I expected. Now, what might happen here is we might get a nice push down now, break this zone that I was expecting. And then all I'd be looking for is a retracement into here and then a sell off like that. It doesn't matter if I get stopped out once or twice before I get into the right trade, because once I get into the right trade, yeah, so that's how I'd probably trade it, waiting for price to come back in like that. Okay, once I get my right trade, well, let's say we get down to here and we sweep that liquidity point. I've taken 4R. So if I take a loss, maybe 2 losses, but I end up in 4R, who really cares? It really makes no difference to me because ultimately I'm winning anyway. This looks like a liquidity sweep, as you can see. Watch out for these on Bitcoin, guys. Bit of advice I'd give you, guys and girls, is Bitcoin is the most manipulated currency in the marketplace. You will be caught out on it over and over again, which is why it's good to stack the confluences in your favor. This is a beautiful liquidity sweep, as you can see. It's tagged me and millions of other people out, and now it's going to probably push down in our general direction. But that's fine. We now just wait for price to return, and we're good to go. So answer to your question, and closing the trade before stop loss, don't. Commit to the trade. If you close that trade before stop loss and it wins, you will kick yourself, and it builds a really bad pattern of behaviors. Do not close the trade before stop loss. Accept that the trade is already a loss, and if it wins, that is a bonus. If you're trading before stop loss, if you're closing before stop loss, you are not experienced enough with your trading plan. You are not back testing. You are not journaling. And you have not got yet enough experience in the marketplace. The answer is do not move your stop loss. Do not close before stop loss. It is as simple as that. Question 4, understanding liquidity. Well, as I mentioned in the comments, this is going to require a full video. I did touch on this in the latest supply and demand zone video, so do go and check that out. Understanding liquidity. Well, price, as it moves up and down, ultimately aims to take people in and out of the marketplace. And the algorithm, the big players, the institutions, the composite man, whatever you want to call them, okay, the aim of the bigger players in the marketplace is to have a clear market. What I mean by that is that the fewer buyers and sellers in the marketplace, the less resistance there is against their trade. For example, this move up here has taken out all this liquidity above here, and there's millions and millions of dollars sat above here, okay, in the form of sell orders with stops above them. We'll mark it red as a sell, okay, buy orders as breakout traders will take, and we'll put them as blue, okay? And there's millions of orders here with stops above the sells and stops above the buys. Sorry, stops below the buys. So when price comes up here and breaks out, what people think is that the price is going to continue. So they place a stop order there, expecting price to do this, okay? What also happens is sellers, they take the trade here, expecting for the big move down here. They place their stop above, buyers place their stop below. What this move does is it sweeps all of them out of the marketplace, okay? He's now gone. She's now gone, okay? Because we've pushed up, we've taken the stops of the sellers. They're now dead, not literally, okay? We've swept up, and then we've pushed down, taken out the stops of the buyers. They're now out of the market. They're dead, gone. So the resistance that they would have had to move the market in the direction they want it to go in from these buyers and sellers, the buyers obviously pushing price up, the sellers obviously pushing price down, they've now swept them out of the marketplace. Now, you may be thinking, well, why would they want sellers out in the marketplace? Because that is in their general direction. Yes, it is in their general direction, but the clearer the market is, the more impact they can have. And let's say the market moves off too quickly. Let's say the market shoots up and then shoots really, really quickly down like this, okay? They may not be ready for that yet. They may have buy orders here. They may have bought the market here, and they may be wanting price to come back down here slowly so they can close all off their orders. How they think is obviously impossible to understand. But if there are loads and loads of sell orders up here and they're not taken out of the marketplace, it could push the market in a direction that they're not quite ready for yet. So the simplest thing for them to do is to have everyone out, both buyers and sellers. And these are what these liquidity moves do. They push the price up, they push price down, and they take everybody out, okay? Now this leads on to our next question, which is question 5, which is understanding breaks of structure. So again, I did go into this in quite a bit of detail in the Beginner to Winner first videos, kind of the market structure videos. I think it's video 3 or 4 in this series. I go into a lot of detail about breaks of structure. There's different types of break of structure, and they're not all equal. As simple as that, okay? Anytime a high point, which is a swing high of any kind, or a low point, which is a swing point of any kind, is broken, okay, this is a break of structure. What a break of structure is this is a structural low, price pushes down, so it's broken. This is a structural low, price pushes down, so it's broken. That, in the simplest of terms, is what breaks of structure are. Now, what we do is we use them in our trading to give us an indication where price is likely to go next, okay? And what we're looking for in my trading style anyway is these more major breaks of structure like we had here, okay? So this was a half decent trade for me, to be fair. I haven't been that lucky on Bitcoin this weekend, but that's okay. It looks like we're going to get our setup into Monday. This break of structure here is this first one, this push down, this wick, doesn't qualify as a clear break of structure. The breaks of structure are relevant to the time frame that you're on. So if it pushes down like this and it only wicks, there's no close, there's no weight, there's no volume to that break of structure. It's just a wick down or a wick up. That could just be a liquidity sweep like we're seeing here. So what does that give us? Nothing to trade. We don't want to be trading a liquidity sweep. We don't want to be seeing that as a break of structure to the high side. So now, that wouldn't be a break of structure in my eyes on this time frame anyway. That's just a wick up and a wick down. Okay, now if you're looking for trades on the 15-minute chart, there has to be a close of price on the 15-minute chart. If you're looking for trades on the 15-minute chart and then you're dropping down to the 3-minute chart and saying, actually, that wick wasn't, but let's say that was a wick on the 15-minute chart, but it was a close on the 3-minute chart, you'd be saying to yourself, oh, do you know what? We've had this break of structure now we're good to go. Well, no, it doesn't work like that. If you're looking for a setup on the 15-minute chart, your breaks of structure have to be on the 15-minute chart as well, which is why that one was valid, that one was valid, but these ones aren't valid on these time frames. That one is, okay? So what we're doing is we're looking for a high time frame zone, like this supply zone we're in here, and then we want to say, right, when price gives us a break of structure, that's an indication price is going to go short. So what we're going to do is we're then going to enter a trade. So that's how we use breaks of structure. Now, there's different forms of breaks of structure, okay? You have what's called minor and major breaks of structure. And I'll talk you through what each one is. This here is a minor break of structure, okay? That's a minor break of structure because the swing low here was not broken. So I just put that as a BOS. Okay, that there as well was technically a minor break of structure. In some person's eyes, it's minor break of structure. Some people see it as a major. The major break of structure could have been that one because it's a swing low. The major break of structure could have been that one because it's a swing low. But as you can see, you've only had wicks there, nothing else. Okay, now these ones here are technically minor breaks of structure on the 15-minute time frame. Why are they minor? Because they haven't broken a swing low. Now this is okay. Okay, we will pay attention to them because they do give us an indication that the trend may be changing, but ultimately it's not the higher time frame major breaks of structure that we're looking for. Okay, that's one type. So a major break of structure is something like this, where price has broken a structural swing high. These are breaks of structure that would, outside of a supply zone, that we're in at the moment indicate to us prices are going to go higher. And to be fair, although it didn't get down to the premium area, some people traded this zone, some people traded it. There are ways to trade this. To be fair, that has continued the trend and it has pushed up again, okay? Now, major breaks of structure are the ones that we pay attention to. This is where we are looking for trades following them. So if this wasn't in a supply zone, what I'd be saying now is, right, we've had this major break of structure, okay? What I'm going to be looking for is, I'm going to be looking for this, okay? Draw on our rangefinder, high to the low, change it to premium discount. We see our zone here, and we see there's a lovely demand zone in here. I'd be looking for a trade. Now, if I was going to be buying this marketplace, that is where I'd be looking for a trade from. Okay, now I'm selling the marketplace. That's where I'm going to be looking for profits from, because that is a major break of structure. And the swing point that originated that major break of structure is this low point here. Okay, that is therefore a zone that once we're in premium and discount, as you can see there in discount here, any zones in this area are now high probability for longs. The only thing that's affecting this is the fact that we're in a higher time frame supply zone. So personally, for me, I would not be looking for a sell from here. Sorry, a buy from here. I'm going to be kind of watching and waiting. Now, one thing I always do when I see the market moving in a direction that I'm pretty happy with, I always leave on. Let's just try and find it. I always leave on a higher time frame risk entry. Often, especially on Bitcoin, often Bitcoin will kind of go without you, okay? And the way I do it is this. I find an area that I'm happy to take a trade from. So after I had this minor break of structure here, okay, with a close, I'm confident that at some point this is going to break down. We saw this another sweep high, and what I do is this. I measure out the stop, which in this instance was 180, and I double it. So wherever price is, I double that above. So that's a 360. So 180 times 2, 360. You can see where I'm going with that. That gives me now my trade enough room to breathe. So although I've been taking out some of my smaller positions, I'm still in a position here, which I will hold. And that's how I take a risk entry. I will then add into my trades. That's how I kind of make my profits, and how when I win big, I'll then add into this as it starts breaking down. This move looks very clearly like a sweep and a break. And what we're going to start seeing now is breaks of structure to the sell side. Okay, let's get rid of that. What we're looking for now to trade this, I'll drop down to the 5-minute chart. Okay, we have had push up, push down, push up, push down, push up. Okay, this is our trend as it currently stands. Okay, like that. Where it goes next, we don't know. Now, these are all on the 5-minute chart, major breaks of structure. It's really important to understand that breaks of structure are relevant to the time frame that you're on. On the 15-minute chart, these would probably be nothing. On the 5-minute chart, these are all major breaks of structure. So we're happy to consider them. Now, you've probably seen all over the socials at the moment a form of trading which talks about chocks or change of character. All a change of character is a break of structure in the opposite direction. So if this does this, okay, and then returns like that and starts going bearish, we see these as a change of character, okay? And what they do is they mark on, I haven't got a template for it because I don't personally use it, but they mark on what they call a chock, okay? And this then indicates that price is likely to then reverse direction, and they would trade it something like this, very similar to the way I trade. I personally don't trade chocks, but if it gives you a good understanding, then that's fine. It's all basically the same thing. Once you've had this change of character, all it means is a break of structure in the opposite way. Once you have this change of character, this isn't another chock, because another chock would be that, of course. 2 seconds. Another chock would be that. That would be a chock, because that is, yes, that's a change of character, but if it pushes back up, then it changes character again. Now we're in a bearish character, if you want to call it that. That just becomes a break of structure, or a major break of structure in our eyes. Now, major and minor breaks of structure, there's multiple ways. That there, see that little spike there? That there is a break of structure, but it is a minor break of structure because it's not a swing low point. Feel free to make a note of these if you want to. I'll clear this chart up just a little bit so you can see what I mean, okay? If price stops trending up and starts breaking down and then breaks this last swing low point, it's a change of character. Okay, I call it a breaker structure, but you can call it a chock if you want. If price continues down and then breaks one of these kind of minor swing lows, then it is just a minor breaker structure. I just call it a BOS. And if price breaks down below a swing low on the time frame that you're on, which is the 5-minute chart here, then that's a major breaker structure. Now, I spoke earlier about how breaks of structure are only relevant to the time frame that you're on. Okay, well, if I'm on the 15-minute chart and this price just wicked below and came back up, although that would be a major breaker structure on the 5-minute chart, on the 15-minute chart, it might just be a breaker structure because it might just be a wick. So that there is a wick, of course. That there is a close, of course. We want to see if you're trading the 15-minute chart, okay, and why you trade the 15-minute or the 5-minute, that's really down to you and your testing. And, you know, for me personally, I wait for a breaker structure in my trading direction on the 5-minute chart. So if we get this push down here, this change of character, this breakdown, this breaker structure, and we get a really nice close and then a return, for me, that's a trade all day long. I'm happy with that. Some people would want the 15-minute chart broken and wait for that change of character on the 15-minute chart. It's really up to you. Personally, I would trade a 5-minute chart for my entries. Some people trade a 15 minutes. Some people trade a 1 minute. It varies, okay? And if you're looking for these, as a rule of thumb, if you're looking for these higher time frame moves and you want the charts to, you know, play out on these kind of hourly zones, these 2 hourly zones, you should be looking for your breaks of structure in your trading direction. You should be looking for them on the 15-minute to the 5-minute. Okay, it really depends on your testing and how you want to do it. But if you're trading the 1 hour chart or the 2 hour chart and you want to confirm an entry by a breaker structure in the direction of your trade, so you're looking for a sell from here, before you take that sell, you're going to be waiting for that breaker structure on the 5-minute chart. Okay, if you want to wait for it on the 15-minute chart and that's what you've tested, then you wait for it on the 15-minute chart. What I wouldn't be doing is building a trading plan around a 15-minute breaker structure and then dropping down to the 1-minute chart or the 3-minute chart and seeing that breaker structure and then entering, because your trade setup's all wrong and your plan's all wrong. Okay, you have to trade how you test. And if you test on the 15-minute chart, then a 3-minute breaker structure does not qualify you to enter a trade. It's as simple as that. And this isn't even a breaker. Well, no, technically it would be, yeah. Okay, now if I traded the 3-minute chart and I look for entries on the 3-minute chart, that now for me is a valid trade. Okay, I take it here. Whereas these people, they might get a really nice trade here. People who are waiting for a 15-minute entry, their 3-minute entry might only get them a 4R. And then what happens is it comes back up and it tags them out of the trade, because on the 15-minute chart, we didn't get a breaker structure. And the 15-minute chart, obviously the higher time frames always carry the most weight, don't they? So the higher the time frame breaker structure is, so if you get a 15-minute breaker structure that pushes down like that, you've got now much more higher probable trade that has broken a 15-minute zone, which is this zone here. Okay, you've now got a much higher probable trade than the 3-minute breaker structure down here, because the 3-minute breaker structure is still limited ultimately, potentially, by this 15-minute swing low. So you see, it's all relative to the time frame that you're trading on. And you've got to be prepared for the fact that if you're trading the lower time frames, your trades aren't going to hold as much. They're going to stop you out more, and they're not going to hold as much. I personally find the 5-minute chart is a really nice compromise. You know, it's a halfway house. I would wait for a proper swing low. So this is a swing low. I mean, that technically is a swing low, but it's not a very clear one. This for me is a really clear swing low. So for me now to short this marketplace, I want price to break and close below this low. And then I'll be framing the entire up move, something like that. And I'll be trading like that. So yeah, I don't get my 3R trade. They get their 3R trade from here, okay, or their 4R trade. I'm only getting 2R trade. But what's my trade more likely to do? Well, now I've got this higher time frame breaker structure, my trade's more likely to go on, because a higher time frame breaker structure is always more reliable than a lower time frame breaker structure. So look, I think that's as kind of comprehensive as I can go. I'll try and do a full video on breaker structure because it's really important to understand it. But I hope that's given you a good insight. If you haven't done so already, please make sure you subscribe to my channel. Do me a huge favor if you enjoyed this video or you learned something today. Please pop a like and a comment below, and obviously hit that notification bell so you can be notified when the next video lands.